Picture this. You're sitting at a kitchen table. Maybe it's your parents' kitchen table. Maybe it's a folding card table in your studio apartment where you eat cereal standing up. And you've just decided you're going to buy a house. Maybe you've been watching too many HGTV renovation shows. Maybe your landlord raised the rent again and you had a very serious conversation with yourself in the shower. Maybe your friend just bought a place and showed you the backyard on a Sunday afternoon, and something in your brain went, yeah, I want that. Whatever the reason, you've made the call. You're doing this. So you do what any reasonable adult does in the 21st century. You Google it. How much house can I afford? And within about 45 seconds, you are buried alive in conflicting information. One calculator says $380,000. Another says $520,000. A Reddit thread from 2019 says you should spend no more than 2.5 times your income. A finance influencer on YouTube, the one with the Lamborghini in his thumbnail, says you're leaving money on the table if you don't buy as much house as the bank will give you. Your mom says to just talk to a realtor. Your coworker says the market is about to crash, wait it out. A Bankrate article gives you a formula that involves 7 different variables, 3 of which you don't understand. You close the laptop. You eat some cereal. You wonder if renting is actually that bad. Here's the thing. Nobody is lying to you. Most of that information has some truth in it. The problem is that the question, how much house can I afford, isn't really a math problem. Well, it is a math problem, a fairly significant one, but it's also a lifestyle problem, a psychology problem, a risk tolerance problem, and occasionally a what do I actually want my life to look like problem. And most of the calculators and articles and Reddit threads answer only part of it, or worse, they answer the easy part while quietly ignoring the part that actually determines whether you end up house happy or house poor. That's what we're going to fix today. Over the course of this video, we are going to build a complete, honest, slightly uncomfortable picture of what you can actually afford, not just what a bank will lend you, not just what the old rules of thumb say, but what makes sense for your actual financial life, including all the costs that home buying articles conveniently leave out of the headline number. We're going to talk about debt-to-income ratios, down payments, interest rates, property taxes, maintenance costs, HOA fees, emergency funds, and the deeply personal question of what being comfortable actually means to you in dollar terms. By the end of this, you will have a real number, or at least a real method for finding your real number, which honestly is more useful than a calculator that doesn't know you're planning to have 3 kids and a rescue greyhound. Let's get into it. Chapter 1. The Rules of Thumb. Nobody should actually follow, but everyone does. Let's start with the rules, because before we build anything, we have to demolish some things, and the things we need to demolish are the overly simple guidelines that get repeated so often they've taken on the aura of financial law. You've heard these. You've probably repeated them. They're not entirely wrong. They're just incomplete in ways that can cost you a lot of money if you follow them uncritically. Rule number 1, spend no more than 28% of your gross income on housing. This one is old. Like, older than the internet old. It comes from mortgage underwriting guidelines that banks developed decades ago as a quick way to screen loan applicants. The idea is simple. Take your gross monthly income, that's before taxes, before your 401k contribution, before anything, and multiply it by 0.28. That's your maximum monthly housing payment, according to this rule. So if you make $80,000 a year, your gross monthly income is about $6,667. 28% of that is $1,867. That's the ceiling. Here's where it starts to get weird. First, gross income is not the money you actually have. If you're in a typical tax bracket, you're taking home somewhere between 70% and 80% of that, maybe less, depending on your state, your benefits elections, and whether you're funding a retirement account. So while your gross is $6,667, your net might be $4,800 or $5,000, and $1,867 out of $5,000 is not 28%. It's more like 37%. That's a very different feeling when the mortgage payment hits your checking account. Second, the 28% rule covers what's called PITI, principal, interest, taxes, and insurance, but not all mortgage calculators include taxes and insurance in their math when they show you what you can afford, and not all home buyers think to add those in. So when someone says, "My mortgage is $1,800 a month," They might mean just principal and interest, which means their actual housing cost is higher once you add property taxes and homeowners insurance. We'll get deep into all of this in Chapter 3, but for now, be skeptical of any number that doesn't include the full picture. Third, and this is the one nobody talks about, the 28% rule says nothing about your other financial obligations. It doesn't know if you have $900 a month in student loans. It doesn't know if you're paying $600 a month in car payments. It doesn't know if you've committed to supporting a family member, or if you're trying to save for retirement, or if you want to, I don't know, go on vacation occasionally without it causing a financial crisis. The 28% rule is a single data point. It was never designed to be the whole answer. It was designed for banks, not for you. Rule number 2, buy a house worth 2.5 to 3 times your annual salary. This one is everywhere. It's easy to remember, it feels authoritative, and it produces a satisfying specific number. Make $90,000, buy a house between $225,000 and $270,000. Make $120,000? You're looking at $300,000 to $360,000. The appeal is obvious, but the problems are significant. Problem 1, this rule was established when interest rates were different. When mortgage rates are at 3%, you can afford a much bigger loan for the same monthly payment as you'd have at 7%. The income multiplier rule bakes in a set of assumptions about the cost of money that may or may not match the current environment. A $300,000 mortgage at 3% is about $1,265 per month in principal and interest. At 7%, it's about $1,996 per month. That's a $731 monthly difference, nearly $9,000 per year for the same house. The rule doesn't adjust for that, it just sits there confidently, ignoring the most important variable in the calculation. Problem 2, it ignores your down payment entirely. The rule is based on home price, not loan size. But if you're putting 3% down versus 20% down, your monthly payment is dramatically different, not just because you're borrowing more, but because with less than 20% down, you're also paying private mortgage insurance, which we'll get to later. 2 people with identical incomes buying identical houses can have very different monthly payments depending on how much they put down. The multiplier rule treats them as identical. They are not. Problem 3. Cost of living is wildly regional, and this rule doesn't account for that at all. If you live in a major coastal city, 2.5 times your salary might not get you a 1-bedroom condo. If you live in a mid-sized Midwestern city, it might get you a 4-bedroom house with a yard. The rule is equally useless in both situations in opposite ways. Rule number 3. The bank approved you for X, so you can afford X. Oh, this one. This one has caused so much suffering. When a bank approves you for a mortgage, they are not doing a holistic analysis of your financial well-being. They are not asking, will this payment leave you with enough money to fund your retirement? Will this mortgage make you miserable and stressed for the next 30 years? Have you accounted for a new furnace, a leaky roof, or a global pandemic that temporarily tanks your income? The bank is asking one question, and one question only. Based on your income and debt, what is the maximum amount we are legally comfortable lending you at an acceptable risk level? That is the entire calculation. It is a business decision, not a personal finance recommendation. The maximum the bank will lend you is almost always more than what you should borrow, sometimes a lot more. The bank's threshold is designed around their risk, not yours. Their worst-case scenario is that you default and they recover the asset. Your worst-case scenario is that you lose your house, destroy your credit, and spend years recovering financially and emotionally. Those are not the same risk profile. There's an old line in personal finance circles, just because you can doesn't mean you should. Nowhere is this more applicable than in the gap between what a lender will approve and what you can actually live comfortably with. We're going to spend the rest of this video figuring out how to find that second number, because that's the only one that matters for your actual life. So, why do these rules persist? Because they're easy. Because they give people a number quickly. Because the alternative, actually sitting down and working through all your income, expenses, debts, goals, risk tolerance, and life plans, is tedious and uncomfortable, and occasionally requires confronting things you'd rather not confront. But we're going to do the tedious thing, because it's the thing that actually works. One more rule worth mentioning briefly, because you'll see it. The 36% total debt rule which says your total monthly debt payments, including your mortgage, shouldn't exceed 36% of your gross monthly income. This is actually the second half of the 28-36 rule, which you'll sometimes see cited together. The 28% is for housing alone. The 36% is for all debt. This is a little more useful than the others because it acknowledges that you might have other debt. But it still uses gross income, it still produces a maximum based on bank logic number, and it still doesn't ask whether that number leaves you with a life you enjoy or just a life you technically survive. It's a starting point, not a finish line. Here's what I want you to take away from this chapter. Every rule of thumb in personal finance is a shortcut, and shortcuts have costs. The cost of using these shortcuts without understanding them is that you might end up buying too much house, stretching your finances thin in ways that affect your quality of life, your retirement savings, your ability to handle emergencies, and your general stress levels for decades. That's a high cost for the convenience of a simple formula. The good news is that doing this right isn't actually that much harder. It just requires a little more math and a lot more honesty. Let's start with the math. Chapter 2, Your Real Numbers, What Lenders See versus What You Feel. Here's the thing about lenders. They live in a world of documentation. They work with W-2s, pay stubs, tax returns, bank statements. They care about what can be proven, verified, and categorized. And the primary categories they care about are income and debt, combined into a ratio called, and you'll hear this term a lot, your debt-to-income ratio, or DTI. DTI is arguably the most important number in the mortgage world. Understanding it will help you understand why you got approved for more or less than you expected, why your application might get denied even though you feel like you make good money, and how to think about your own numbers before you even walk into a lender's office. Let's break it down. What is debt-to-income ratio? Your debt-to-income ratio is exactly what it sounds like. The percentage of your gross monthly income that goes toward debt payments. Lenders typically look at two versions of it. The first is called the front-end ratio, sometimes called the housing ratio or pity ratio. This is just your proposed monthly housing payment, principal, interest, taxes, and insurance, divided by your gross monthly income. The second is the back-end ratio, sometimes called the total DTI. This takes your proposed housing payment plus all your other monthly debt obligations, car loans, student loans, credit card minimum payments, personal loans, any other installment debt, and divides that total by your gross monthly income. Most conventional lenders want to see a front-end ratio below 28%, there's that number again, and a back-end ratio below 36% to 43%, depending on the loan type and the lender. FHA loans, which are government-backed and often used by first-time buyers, can be somewhat more flexible. They sometimes allow back-end DT is up to 50% or even slightly higher in certain cases, though that is getting into territory where your monthly budget is going to feel genuinely uncomfortable. Let's do an example so this becomes real instead of abstract. Say you make $85,000 a year. Your gross monthly income is $85,000 divided by 12, which is $7,083. You have the following monthly debt payments: student loans, $400, car payment, $350, credit card minimum, $75. That's $825 in monthly debt before the mortgage. Now you want to buy a house. The lender wants your back-end DTI to be at or below 43%. So the maximum total monthly debt they want to see is 43% of $7,083, which is $3,046. Subtract your existing debt. $3,046 minus $825 is $2,221. That's the maximum monthly housing payment the lender is willing to count, including taxes and insurance. If you're in an area where property taxes and homeowners insurance add up to $500 a month, which is not unreasonable in many markets, then you're left with $1,721 for principal and interest. At a 7% interest rate on a 30-year mortgage, that monthly payment corresponds to a loan of roughly $258,000. With 5% down, that means you're looking at a home price in the range of about $272,000. Now here's the uncomfortable part. Let's look at what actually lands in your bank account every month. $85,000 gross. After federal income tax, let's say you're in the 22% bracket, though your effective rate will be lower. State income tax, let's assume a moderate state, around 5%. Social Security and Medicare, 7.65%. And a reasonable retirement contribution, let's say 6% to a 401k, your take-home is probably somewhere around $4,600 to $5,000 per month, depending on your specific situation, and from that, you're being asked to spend $2,221 on housing alone. That's roughly 44 to 48% of your take-home pay, plus the $825 in existing debt. That leaves maybe $1,000 to $1,500 per month for everything else: food, utilities, transportation, beyond the car, payment, clothing, healthcare, out-of-pocket costs, subscriptions, entertainment, gifts, vacations, and any savings beyond your 401k contribution. $1,000 to $1,500 per month for all of that. Does that feel affordable to you? In a technical bank-approved sense, yes. In a practical, daily life sense, that might be one of the most stressful budgets you've ever tried to maintain. This is the gap we need to talk about. The gap between what a bank will approve and what will actually feel manageable. The income problem, what counts and what doesn't. Before we go further, we need to talk about what income actually counts toward your DTI calculation, because it's not always as straightforward as it seems. The most straightforward case is a salaried W-2 employee. You get a consistent paycheck, you have a W-2, the lender adds up your annual salary, divides by 12, and that's your monthly gross income. Easy. But life is complicated. Many people have income that's harder to document. If you're self-employed, a freelancer, a gig worker, or a 1099 contractor, lenders typically use your net income from your tax returns, specifically your Schedule C, averaged over the last 2 years. This is important because many self-employed people take significant deductions that reduce their taxable income, which is great for taxes and bad for mortgage qualification. Your reported income to the IRS might be significantly lower than what you actually take home in cash. The bank cares about what's on the tax return, not what's in your checking account. If you have a side hustle, overtime income, bonuses, or commission income, lenders will typically want to see a 2-year history of that income and will average it before including it in your qualifying income. They won't just take your word for it that your boss usually pays out bonuses. Rental income, investment income, alimony, child support, all of these can potentially count, but they each come with their own documentation requirements and verification rules. The point here is that your qualifying income for mortgage purposes might be different, sometimes significantly different, from your actual cash flow. Before you run any affordability calculations, it's worth having a realistic conversation with a lender or mortgage broker about what they'll actually count. The debt problem, what shows up that you might forget. On the debt side, there are also a few surprises waiting for you. Credit cards. Lenders don't count what you actually pay each month. They count the minimum payment on your statement balance. If you pay your card off in full every month, but your statement shows a $3,000 balance with a $60 minimum payment, that $60 shows up in your DTI. This generally works in your favor if you're a responsible card user. Student loans. Here's where it gets complicated. If your student loans are an income-driven repayment, IDR, and your required payment is $0 or very low, different loan types handle this differently. Conventional loans might use 1% of your outstanding balance as the assumed monthly payment, even if your actual payment is less. FHA loans have their own rules. The specific treatment varies and can affect your DTI significantly. Car leases, counted as debt, just like car loans. Co-signed loans, if you co-signed a loan for someone else, a family member's car, a roommate's apartment, if it's a co-signed personal loan, those obligations typically show up on your credit report and get counted in your DTI, even if you're not the primary payer. This surprises a lot of people. The credit score conversation. We can't talk about what you can afford without a brief detour into credit scores, because your credit score doesn't just determine whether you get approved for a mortgage, it significantly affects the interest rate you're offered, which dramatically affects your monthly payment and the total cost of the loan. Here's a quick illustration. Let's say you're buying a $350,000 home with 10% down, so you're financing $315,000 on a 30-year mortgage. If your credit score is 760 or above, considered excellent, you might qualify for a rate around 6.75%, using rough current market numbers. Actual rates change constantly, so this is illustrative. Your principal and interest payment would be about $2,043 per month. If your credit score is 680, decent, but not excellent, you might see a rate more like 7.25%. Your payment goes to $2,149 per month. That's $106 more per month, or $1,272 per year, or $38,160 over the life of a 30-year loan, just from the rate difference. If your score is below 620, you may struggle to qualify for a conventional loan at all, or you'll be paying significantly higher rates through alternative loan products. The takeaway here isn't to stress you out about your credit score, it's to make the point that your credit score is a financial lever, and it's one worth pulling before you apply for a mortgage. Paying down credit card balances, disputing errors on your report, and avoiding new credit inquiries in the months before you apply can all move your score in the right direction. Even a 20 to 40 point improvement in your credit score can sometimes save you enough on your interest rate to make a meaningful difference over the life of the loan. Building your real picture. Okay, so now we've established the lender's framework, DTI, qualifying income, credit score. That's what they see. But as we've established, what they see and what you should actually do are two different things. Here's a better framework for thinking about your own numbers from your own perspective. Step 1. Calculate your actual take-home income, not gross, not what's on your offer letter. The actual number that hits your bank account every month after taxes, insurance, retirement contributions, and any other payroll deductions. This is your real money. Step 2. List all your current monthly expenses, not just debts, but everything. Rent, utilities, groceries, transportation, subscriptions, gym, dining, clothing, haircuts, pet costs, medical copays, gifts, travel, and everything else. Be honest. Look at your actual bank and credit card statements. People consistently underestimate their own spending by 15 to 25%. Step 3. Identify what you're currently saving. Are you contributing to retirement, building an emergency fund, saving for other goals? Be honest about what you want to maintain, because a house payment that wrecks your retirement contributions isn't actually affordable. It's just deferred unaffordability. Step 4. Subtract all of those from your take-home pay. The number left over is what you could theoretically direct toward a mortgage payment. And even then, you want some cushion. Housing is never the only cost of home ownership, and we'll spend all of Chapter 3 exploring the things that will eat into that number. This exercise usually produces a number that is notably lower than what the bank will approve. That's normal. That's the point. The bank's job is to lend you money. Your job is to live your life. A word on the just stretch a little mentality. There's a pervasive attitude in home buying culture that it's okay to stretch a little, to buy a bit more house than feels comfortable because you'll grow into it. Your income will go up. You'll figure it out. It's an investment. It always appreciates. Some of those things are true. Incomes do tend to go up over time. Home values have historically appreciated. These aren't lies. But stretching has costs that don't show up in the mortgage calculator. When your housing payment is too high, everything else in your budget gets compressed. You skip the car maintenance because the mortgage is due. You don't start the emergency fund because every spare dollar is earmarked for the house. You don't save for retirement at the rate you should. You say no to opportunities, a vacation, a career risk, a health expense, because the house is already consuming the margin. And when something goes wrong, a job loss, a medical bill, a major repair, you have no buffer. The stretch didn't leave you any room to absorb a shock, and the shock is now a crisis. Stretching a little is often fine if it means buying a $320,000 house instead of a $300,000 house. It is not fine if it means buying a $500,000 house when your comfortable number is $350,000. The word little is doing a lot of work in that sentence, and people who end up in financial distress usually told themselves they were only stretching a little. We'll come back to the concept of buffers and margins later. For now, let's get into the part that almost every affordability calculator ignores: the actual cost of owning a home after you buy it. Chapter 3. The hidden costs of home ownership. The stuff nobody puts in the brochure. Here's a sentence that will Either confirm something you already suspected or completely rearrange your understanding of homeownership. Your mortgage payment is not your housing cost. Your mortgage payment is one component of your housing cost. It is often not even the majority of it, depending on where you live and what you buy. The true cost of owning a home is a layered, sometimes surprising, occasionally infuriating collection of expenses that starts the day you close and doesn't stop until the day you sell, and sometimes continues even then. The reason this matters for affordability is obvious. If you calculate what you can afford based only on the mortgage payment, you're working with incomplete information. You might buy a house that fits comfortably in your budget on paper, and then spend the next decade quietly suffocating under all the costs that weren't in the calculation. We are going to fix that right now. In this chapter, we're going to walk through every major category of homeownership. Cost, explain how to estimate it, and give you a realistic sense of how much it all adds up to. Some of this will be familiar, some of it will surprise you, a little bit of it might make you want to call your landlord and apologize for every passive-aggressive maintenance request you ever submitted. Let's go category by category. Cost number 1. Property taxes. Property taxes are one of the most significant ongoing costs of homeownership, and they are also one of the most variable, wildly different from state to state, county to county, and sometimes even neighborhood to neighborhood. The basic mechanism is simple. Your local government assesses the value of your home periodically and charges you a percentage of that value each year as a property tax. The percentage is called the mill rate or the tax rate, and it varies enormously. In Hawaii, the effective property tax rate is about 0.3%. In New Jersey, it's closer to 2.2%. The national average is roughly 1.1%, but that average is almost meaningless because the range is so wide. Let's put some dollar amounts on this. If you buy a $350,000 home at 0.5%, $1,750 per year, or about $146 per month. At 1.0%, $3,500 per year, or about $292 per month. At 1.5%, $5,250 per year, or about $438 per month. At 2.0%, $7,000 per year, or about $583 per month. At 2.5%, $8,750 per year, or about $729 per month. That is a range of $146 to $729 per month for the exact same house in different locations. If you've been running affordability numbers without factoring in the property tax rate for the specific area where you're buying, you may be significantly underestimating your monthly housing cost. A few things to know about property taxes. First, they tend to go up over time, either because the tax rate increases or because your home's assessed value increases, or both. If you buy a house and the market appreciates significantly, don't be surprised to see your property tax bill increase in subsequent years. Second, many states offer exemptions or credits that can reduce your bill. Homestead exemptions for primary residences are common. Find out what's available in your area. Third, if you're buying a home that was previously owned by someone who qualified for a senior discount or a long-term homeowner cap, the assessed value, and therefore the tax bill, may jump significantly after the sale. This is a real gotcha that catches buyers off guard. How to find the actual property tax on a specific house you're considering? Look it up. Most counties have public tax records searchable by address. You can also ask your real estate agent or simply call the county assessor's office. Don't estimate. Look up the actual number. Cost number 2, homeowner's insurance. Homeowner's insurance is not optional. Your lender will require it as a condition of the mortgage, but required doesn't mean the cost is fixed or predictable. Homeowner's insurance premiums vary based on your location, the age and condition of the home, the replacement cost of the structure, your deductible, your claims history, and a variety of other factors. As a rough national average, homeowner's insurance costs somewhere around $1,200 to $2,000 per year for a standard single-family home, but this is another number where the range swings wildly. If you're in Florida, where hurricane risk drives up premiums, you might pay $3,000 to $5,000 per year or more. If you're in a high fire risk area of California, you might find that standard insurers won't cover you at all, and you're stuck with state-backed insurance that's even more expensive. Coastal states, tornado-prone states, flood-prone areas, insurance costs more everywhere that nature has strong opinions. And speaking of flood, standard homeowners insurance does not cover flood damage. Not even a little. If you're buying in a FEMA-designated flood zone, your lender will require you to also purchase separate flood insurance, which is typically issued through the National Flood Insurance Program. Flood insurance premiums can range from a few $100s a year to several thousand, depending on the flood risk designation and the coverage amount. Here's the move. Before you fall in love with a house, get a rough insurance quote. You can do this online in about 10 minutes. Just call an insurance agent or use an online tool and give them the address and some basic information about the property. The number you get won't be exact, but it'll be in the right ballpark, and it might save you from being blindsided. Cost number 3, private mortgage insurance, PMI. If you put less than 20% down on a conventional mortgage, your lender will require you to pay private mortgage insurance. This is insurance that protects the lender, not you. In the event that you default, you pay the premiums. They get the protection. It is one of the more charming arrangements in personal finance. PMI typically costs between 0.5% and 1.5% of the loan amount per year, depending on your credit score, your loan-to-value ratio, and the lender. On a $300,000 loan, that's $1,500 to $4,500 per year, or $125 to $375 per month. The good news, PMI isn't forever. Once you've built enough equity in the home, typically 20% of the original purchase price, you can request that the lender cancel PMI. Under the Homeowners Protection Act, lenders are required to automatically cancel PMI once your loan balance reaches 78% of the original purchase price, assuming your payments are current. Some lenders are more cooperative than others about processing this promptly, so it's worth tracking and being proactive. FHA loans have their own version of mortgage insurance called the Mortgage Insurance Premium, or MIP. FHA MIP works differently from conventional PMI in a few important ways. First, there's an upfront MIP charge, 1.75% of the loan amount, that's typically rolled into the loan. Second, the annual MIP, which is paid monthly, applies for the life of the loan in many cases, meaning it doesn't go away when you hit 20% equity the way conventional PMI does. This is a meaningful long-term cost that sometimes gets underemphasized when people are excited about FHA loans' lower down payment requirements. FHA loans have genuine advantages, especially for buyers with lower credit scores or limited down payment funds, but the ongoing MIP cost is real and should be factored in. Cost number 4, HOA fees. If you're buying a condo, a townhome, or a home in a planned community with shared amenities, there is a very good chance you will be paying homeowners association fees. HOA fees cover the maintenance of common areas, shared amenities, pool, gym, landscaping, and often include some components of building maintenance if you're in a multi-unit structure. HOA fees range from roughly $100 to $500 per month for a typical planned community or townhome development, and can go much higher for luxury condos or communities with extensive amenities. Some condo associations in major cities charge $800, $1,000, or more per month. Luxury high-rise condos in major cities can have HOA fees of $2,000 plus per month. Here's what people often miss. HOA fees tend to increase over time. They also don't always cover everything you might expect. Many HOAs have special assessments, one-time charges for major shared expenses like a new roof on a condo building, a repaved parking lot, or a pool resurfacing. You can't predict these in advance, but you can ask the HOA board about the reserve fund status and any known upcoming projects. A well-funded HOA reserve is a good sign. An underfunded one is a flag. Also worth knowing, HOA rules can significantly affect what you can do with your property. Painting your front door a non-approved color, parking your pickup truck in the driveway, running a home-based business, renting the property on Airbnb. Many of these are restricted or prohibited in various HOA agreements. This isn't a financial cost, but it's a lifestyle cost, and for some people it matters more than the monthly fee. Before buying in an HOA community, Review the HOA's financial documents and meeting minutes. This is information you're legally entitled to as part of the due diligence process. It can tell you a lot about the financial health and general drama level of the community you're about to join. Cost number 5, maintenance and repairs. This is the category that most first-time homeowners dramatically underestimate, and the one that causes the most financial pain in the years after buying. When you rent, maintenance is largely someone else's problem. The water heater dies, you call the landlord, the furnace stops working in January, you shoot a strongly worded text and someone shows up. You may be inconvenienced, but you don't write a check. When you own, every single thing that breaks or wears out or needs maintenance is your check to write. The roof, the HVAC system, the water heater, the electrical panel, the plumbing, the gutters, the driveway, the deck, the appliances, the windows, the foundation, the siding, all of it. You are the landlord now. Congratulations. How much should you budget for maintenance? The conventional wisdom has a few variations. The 1% rule. Budget 1% of the home's purchase price per year for maintenance and repairs. So a $350,000 house would need $3,500 per year set aside. The 1 to 2% rule. Similar, but acknowledges that the right number depends on the age and condition of the home. A 30-year-old house with original systems needs more than a 5-year-old new construction. The square footage rule. Budget $1 per square foot per year. A 1,800 square foot house would need $1,800 per year. These are all rough approximations, and many housing experts argue they're actually too low for older homes. A house with a 15-year-old roof, a 12-year-old furnace, and a 10-year-old water heater is a house that will very soon need 3 significant repairs, each of which cost anywhere from $3,000 to $15,000. The 1% rule doesn't really capture that bunching of expenses. Here's what the realistic landscape of maintenance costs looks like. These are approximate costs for common major repairs and replacements. New roof, $8,000 to $20,000 depending on size and materials. Lifespan, 20 to 30 years for asphalt shingles. HVAC replacement, $5,000 to $12,000. Lifespan, 15 to 25 years. Water heater, $1,000 to $3,500 installed. Lifespan, 8 to 12 years for traditional, 15 plus for tankless. Electrical panel upgrade, $2,000 to $4,000. New windows per window, $400 to $1,000 installed. A whole house window replacement can run $10,000 to $25,000. Foundation repair, wildly variable, from $2,000 for minor crack sealing to $50,000 plus for serious structural issues. Sewer line replacement, $3,000 to $15,000. Deck repair or replacement, $3,000 to $20,000. Kitchen appliances, full set, $3,000 to $10,000. These aren't catastrophes. They're normal. Every home goes through them. The ones who handle them fine are the ones who planned for them. The ones who are blindsided are the ones who put every spare dollar into the down payment, bought at the top of their budget, and had nothing left when the furnace made an ominous noise in February. One practical way to reduce your maintenance risk when buying: get a thorough home inspection, and not just a standard one if the property is older. Consider specialized inspections for the sewer line. A camera inspection is typically $150 to $300 and can reveal tree root intrusion or deterioration before it becomes catastrophic. The roof, the HVAC system, and if applicable, the chimney and fireplace. An inspector who finds $10,000 in upcoming maintenance issues is giving you information you can use, either to negotiate the price, ask for seller concessions, or decide to keep looking. Cost number 6. Utilities. Renters often have some utilities included in their rent, or they rent smaller spaces that are cheaper to heat, cool, and power. Homeowners generally have larger spaces, pay for all utilities themselves, and sometimes inherit inefficient older systems. Utilities that you may not have paid before, or that may increase significantly as a homeowner: electricity, natural gas, or heating oil or propane, water and sewer, trash collection, and internet. Some rental situations include this. In older homes with poor insulation, drafty windows, or inefficient HVAC systems, utility bills can be surprisingly high. A rough national average for utilities in a single-family home is somewhere around $200 to $400 per month, but this varies enormously by climate, home size, and efficiency. Heating an older 2,500 square foot house in Minnesota through a cold winter can cost $400 to $600 a month in natural gas alone. Cooling a large house in Phoenix in July can do similar damage to your electric bill. Before buying, ask the current owner for 12 months of utility bills. This is completely reasonable to request and gives you real data instead of estimates. If they can't or won't provide them, that's worth noting. Cost number 7, closing costs. Technically a one-time cost rather than an ongoing one, but it's worth including here because it significantly affects the cash you need at the time of purchase, and therefore affects how much you have left afterward. Closing costs typically run 2% to 5% of the purchase price, and they cover a laundry list of items: loan origination fees, title insurance, title search, appraisal fee, attorney fees in states that require attorneys at closing, recording fees, prepaid property taxes, prepaid homeowners insurance, prepaid mortgage interest, covering the days from closing to the first mortgage payment, and others. On a $350,000 home, 3% closing costs is $10,500 on top of your down payment. This is a number that catches some buyers off guard, especially those who scrape together just enough for the down payment without accounting for closing costs. Some of these costs can be rolled into the loan, increasing your loan balance. Some can be negotiated with the seller in the form of seller concessions, and some are simply fixed. Your lender is required to give you a loan estimate within 3 business days of your application, which will itemize all expected closing costs. Review it carefully. Putting it all together, the true monthly cost. Let's do a realistic example to show you what the total monthly cost of homeownership actually looks like versus what people often see in the headline mortgage payment. Suppose you buy a $350,000 home with 10% down, $35,000, and finance $315,000 at 7% for 30 years. Here's what a lot of people calculate. Principal and interest, $2,096. Here's what they're actually paying every month. Principal and interest, $2,096 property tax at 1.2%, $350. Homeowners insurance, $140 PMI at 0.7%, $184 HOA if applicable, $200 maintenance reserve, 1% annually, $292 total, $3,262 per month, and that's without HOA, which would push it to $3,462. That's 56% more than the headline mortgage number, and utilities aren't even in there yet. This isn't meant to scare you. It's meant to make sure your affordability calculation reflects reality. When you know the true cost, you can make a true decision. The opportunity cost. Nobody mentions there's one more cost of homeownership that deserves at least a brief mention, and it's the hardest to quantify: opportunity cost. The money you put into a down payment is money that isn't invested in the stock market. The money you spend on maintenance is money that isn't going into a retirement account. These aren't reasons not to buy a house. Homeownership has genuine financial and personal benefits, but they're part of the full picture. The comparison between buying and renting is genuinely complicated, and anyone who tells you it's obvious is probably selling something. Owning builds equity and can build long-term wealth. It also ties up capital, comes with ongoing costs, and carries risks that renting doesn't. Whether buying makes sense financially versus renting in your specific market, at your specific life stage, with your specific financial situation is a calculation worth doing, and we'll touch on it again in Chapter 6. For now, just keep in mind that the cost of owning a home is not the mortgage payment. It's the mortgage payment, the taxes, the insurance, the PMI if applicable, the HOA if applicable, the maintenance, the utilities, and the opportunity cost of the capital you put in. Add those up, use that number. That's the number that should drive your affordability decision. Chapter 4. How interest rates are quietly destroying your budget, or why the same house costs completely different amounts. Interest rates are boring. They are expressed as small percentages. They get discussed in monotone by central bankers in expensive suits. People's eyes glaze over when mortgage rates come up at parties. If anyone is still bringing up mortgage rates at parties, which depending on your friend group may or may not be happening. But interest rates are arguably the single most powerful variable in your home affordability calculation. More than your income, more than your down payment, more than the price of the house itself in some scenarios. Understanding how interest rates really work, not just higher rate means higher payment understanding, will fundamentally change how you think about buying a home and when to do it. So let's fix the boring problem. We're going to make interest rates interesting by showing you exactly what they cost you in dollar terms. The mechanics of a mortgage first. Let's make sure we're on the same page about how a mortgage actually works, because a lot of people know the general concept but not the mechanics. And the mechanics are where the interesting and slightly horrifying stuff lives. When you get a mortgage, you're borrowing a sum of money and agreeing to pay it back over time with interest. Your monthly payment is designed to pay both interest and principal, the actual loan balance, over the life of the loan, so that at the end of your term, typically 30 years, you owe nothing and own the home free and clear. Here's the part people don't fully internalize. Your payment is the same every month, but the proportion of that payment going to interest versus principal changes dramatically over time. In the early years, the vast majority of your monthly payment is interest. In the later years, it shifts the other way. Let's use a concrete example. You borrow $300,000 at 7% for 30 years. Your monthly payment is $1,996. Your very first payment, $1,750, goes to interest. Only $246 goes to paying down the principal. You've had that $300,000 for 1 month and it cost you $1,750 in interest. By year 10, it's shifted somewhat. Around $1,500 in interest, $496 in principal per month. By year 20, around $1,100 in interest, $896 in principal. By year 29, mostly principal, very little interest. This phenomenon is called amortization, and understanding it matters for a few reasons. First, it means that in the early years of your mortgage, you're mostly paying interest, which means you're building equity slowly at first. Second, it means that if you sell the house after 5 or 7 years, which many people do, the average American moves every 7 to 13 years, you've paid a lot of interest and paid down relatively little principal. You're not throwing money away the way renters supposedly do, but you're not building equity as fast as the simple math of home appreciation might suggest either. The total cost of a mortgage, a number that will make your eyes water. When people shop for mortgages, they focus on the monthly payment. Can I afford $2,000 a month? That's the question. But the monthly payment isn't the real cost of the mortgage. The real cost is the total amount you'll pay over the entire term. Let's look at a $300,000 mortgage at various interest rates. 30-year term at 4% interest. Monthly payment $1,432. Total paid over 30 years $515,609. Total interest $215,609. At 5% interest, monthly payment $1,610. Total paid $579,767. Total interest $279,767. At 6% interest, monthly payment $1,799. Total paid $647,515. Total interest $347,515. At 7% interest, monthly payment $1,996. Total paid $718,527. Total interest $418,527. At 8% interest, monthly payment $2,201. Total paid $792,420. Total interest $492,420. Read those numbers again. At 4%, you pay $215,609 in interest over 30 years on a $300,000 loan. At 8%, you pay $492,420. That's a difference of almost $277,000 in interest alone, nearly the original loan amount, just from the rate difference. The house costs the same, the rate is different, and over the life of the loan, the difference is enormous. Now, this doesn't mean you should refuse to buy a house when rates are high and only buy when rates are low. You don't get to choose when in your life you're ready to buy, and timing the housing market is notoriously difficult. But it does mean that understanding the true cost of different rates helps you make better decisions about how much to borrow, whether to pay points to lower your rate, how aggressively to pay down the mortgage if you end up with a higher rate, and whether refinancing makes sense if rates drop, how interest rates affect what you can buy. Here's the more immediate affordability impact. The same monthly payment buys dramatically different amounts of house at different interest rates. Let's say your budget, the amount you've actually decided you can afford using the real costs from Chapter 3, allows for $1,800 per month in principal and interest. At 4% interest on a 30-year loan, $1,800 per month supports a loan of about $376,000. Add a 10% down payment, and you're looking at a $418,000 home. At 5.5% interest, $1,800 per month supports about $317,000. With 10% down, roughly a $352,000 home. At 7% interest, $1,800 per month supports about $270,000. With 10% down, roughly $300,000. At 8%, $1,800 per month supports about $246,000. With 10% down, roughly $273,000. The same monthly budget, the same down payment percentage, but the home price ranges from $418,000 to $273,000, a difference of $145,000 purely because of interest rates. That is not a small number. That is the difference between a 2-bedroom condo and a 4-bedroom house in many markets. It's the difference between different school districts, different neighborhoods, different life configurations entirely. This is why the housing market often slows significantly when rates rise. It's not just that mortgages cost more, it's that buyers' purchasing power is materially reduced, and sellers who got used to 2021 prices can't always find buyers who can afford them at 7% rates. The math simply doesn't work for as many people. Fixed versus adjustable rate mortgages. The most common mortgage is the 30-year fixed-rate mortgage. The rate is set when you close and it never changes. Your principal and interest payment is identical in month 1 and month 359. That predictability is genuinely valuable. It protects you from rising rates and allows you to plan your budget with confidence. But fixed isn't the only option. Adjustable rate mortgages, or ARMs, offer a different structure. A fixed rate for an initial period, typically 5, 7, or 10 years, followed by periodic adjustments based on a market index plus a margin. The appeal of an ARM is that the initial rate is usually lower than a comparable fixed rate, sometimes meaningfully so. A 7/1 ARM might offer a rate a half point to a full point lower than a 30-year fixed, on a large loan that's real money in the short term. The risk is obvious. After the fixed period ends, your rate adjusts. If rates have gone up, your payment goes up. There are caps on how much the rate can change at any single adjustment and over the life of the loan, but capped doesn't mean small. A rate that jumps from 5% to 8% over a few adjustment periods could increase your monthly payment by hundreds of dollars. ARMs can make sense in specific situations. If you're confident you'll sell the property before the fixed period ends, if rates are historically high and you're betting on refinancing into a lower fixed rate later, or if the loan amount is very large, jumbo mortgages, where even a small rate advantage is significant. They can also blow up in your face if your plans change, rates spike, and you're stuck with an adjusting mortgage you can no longer manage. The phrase adjustable rate mortgage carries some heavy historical baggage for a reason. Many of the foreclosures during the 2008 housing crisis involved ARMs that adjusted upward just as housing values crashed, leaving people underwater with unmanageable payments. The rule of thumb most financial advisors give: if you're planning to own the home long term, a fixed rate provides peace of mind and planning certainty that is usually worth the slightly higher initial rate. If you have a specific shorter-term horizon and you understand the risks, an ARM can be a reasonable tool. Points. Buying down your rate. When you get a mortgage, you'll often have the option to pay points, also called discount points, to lower your interest rate. 1 point equals 1% of the loan amount, and each point typically reduces your rate by about 0.25%. though the exact relationship varies by lender and market conditions. So, on a $300,000 loan, 1 point costs $3,000 and might reduce your rate from 7% to 6.75%. Your monthly payment drops from $1,996 to $1,946, a savings of $50 per month. Is it worth paying $3,000 up front to save $50 per month? That depends on how long you stay in the house. If you divide the upfront cost by the monthly savings, you get your break-even point. $3,000 divided by $50 per month is 60 months, 5 years. If you stay longer than 5 years, paying the point was worth it. If you sell before that, you spent $3,000 to save less than $3,000. Points make the most sense when you're confident about staying in the home for a long time and when you have the cash available without depleting your emergency fund or reducing your down payment in ways that trigger PMI. The refinancing question. If you buy at a high rate, you're not necessarily stuck with that rate forever. Refinancing, taking out a new mortgage to replace your old one, ideally at a lower rate, is an option if rates decline. The common advice is to refinance when rates drop enough to make it financially worthwhile, considering the closing costs, which for a refinance typically run 2 to 3% of the loan amount, or around $5,000 to $10,000 for most mortgages. There's an old rule of thumb that you should refinance when rates drop by 1 percentage point or more, but that's overly simple. The right answer depends on how much you'll save monthly, what you'll pay in closing costs, and how long you plan to stay. There's also a psychological trap to be aware of. People who buy at high rates sometimes make budget decisions based on the assumption that they'll just refinance when rates drop, and rates don't drop, or don't drop enough, or drop at a time when the homeowner can't qualify due to changed circumstances. Don't build your affordability math around a hoped-for refinance. Build it around the rate you actually have, and treat a future refinance as a bonus if it happens. Rate shopping, the most underutilized tool in home buying. Here's something that many homebuyers don't do and should. Shop their mortgage rate aggressively. Mortgage rates are not like gas station prices, where there's a posted number and everyone pays it. Different lenders offer different rates for the same borrower, and the variation can be meaningful. Studies have consistently found that borrowers who get multiple quotes save money compared to those who take the first offer. The Consumer Financial Protection Bureau has data suggesting that getting 5 quotes instead of 1 saves the average borrower around $3,000 over the life of the loan. Other estimates put the savings even higher. Why don't more people do this? Because it feels complicated and time-consuming, and because people worry that multiple credit inquiries will hurt their score. That second concern is largely a myth, by the way. When it comes to mortgage shopping, credit bureaus treat all mortgage inquiries within a 45-day window as a single inquiry for scoring purposes. You can get quotes from 10 lenders in a month, and it counts the same as one inquiry. Who you should be getting quotes from: traditional banks, credit unions, often competitive on rates, online lenders, and mortgage brokers who can shop multiple wholesale lenders on your behalf. Different channels often have different rate structures, and the one that's cheapest for your specific profile isn't always obvious in advance. Compare apples to apples. Look at the total cost of each loan, including origination fees and points, not just the interest rate. What to do if you're buying at high rates. If you're reading this during a period of elevated mortgage rates and feeling like you've drawn the short straw compared to people who bought when rates were at historic lows, which was essentially 2020 and 2021, that frustration is understandable. The difference in purchasing power between buying at 3% and buying at 7% is enormous, and there's no way to fully compensate for it. But there are things you can do. First, run your numbers at the rate you'll actually get, not the rate you wish you could get. Budget reality beats wishful thinking every time. Second, buy less house. Higher rates mean lower purchasing power. Rather than stretching to try to replicate the buying power people had at lower rates, calibrate your expectations and your house search to what the current rate allows without financial strain. Third, consider a larger down payment if you have the funds, since this reduces the loan amount and therefore the interest expense. There are limits to this logic. You don't want to wipe out your emergency fund or retirement savings, but if you have the capacity, a larger down payment is more valuable at higher rates. Fourth, consider an ARM if your circumstances genuinely warrant it. As discussed above, a lower initial rate can provide real payment relief in the short term, especially if there's a reasonable expectation that rates will come down and you'll refinance. Fifth, improve your credit score before buying if possible. At higher rate environments, the premium for excellent credit versus good credit, in terms of the rate you're offered, tends to be more significant. A 700 score versus a 760 score may represent a larger rate gap when rates are elevated. And sixth, recognize that rate environments change. People who bought at 18% in the early 1980s refinanced repeatedly as rates fell. People who bought at 7% in 2023 and 2024 may well refinance if rates moderate, or they may not, and the rate they have is the rate they live with. Either way, the decision to buy or not should be based on your current real numbers, not on what you hope rates will do in the future. One more thing about interest rates, the psychological dimension. There's something subtle that happens to people when they're shopping for homes at high-rate environments. They tend to focus intensely on the monthly payment because it feels manageable to optimize for, and in the process they sometimes ignore the total cost of the loan. "I can handle $2,200 a month" is a concrete, graspable statement. "I will pay $492,000 in interest over 30 years is abstract and disturbing and easy to push to the back of your mind. Neither framing is wrong. The monthly payment is what you're actually living with, but the total cost matters too. It matters when you think about whether to pay extra principal, whether to refinance, whether to take a shorter loan term, and whether the overall deal makes sense relative to your wealth-building goals. A 15-year mortgage at the same rate carries a higher monthly payment, but dramatically reduces the total interest paid. On our $300,000 example at 7%, a 30-year loan means total interest of $418,527 over the life of the loan. A 15-year loan at the same rate means a monthly payment of $2,696 instead of $1,996, $700 more per month, but total interest of only $185,282. You save $233,000 in interest over the life of the loan by making a $700 larger payment for 15 years instead of 30. That is a genuinely dramatic difference that deserves to be in your mental picture when you're deciding on a loan structure. Whether a 15-year mortgage is right for you depends on your income stability, your other financial goals, and whether the higher payment leaves you enough margin for everything else. But it's worth knowing the number so you can make a fully informed choice. Alright, we've covered the lender framework, the real costs of home ownership, and the brutal arithmetic of interest rates. In the next chapter, we're going to talk about down payments, how much you actually need, where it comes from, what different amounts actually change about your monthly picture, and the question of whether more down payment is always better. Chapter 5. Down payments. How much, from where, and what? It actually changes. Let's talk about the down payment. Specifically, let's talk about the mythology surrounding it, the reality of what different down payment amounts actually do to your finances, where people actually get this money, and the question that doesn't get asked nearly enough, is a bigger down payment always better? If you grew up hearing that you need 20% down to buy a house, you absorbed a piece of conventional wisdom that is, to be charitable, outdated, and, to be less charitable, a piece of outdated conventional wisdom that has caused a significant number of people to delay homeownership for years while they save toward a target that wasn't actually necessary. The 20% figure has been gospel and home buying advice for decades, but the actual mortgage landscape looks quite different. Let's clear the air, then dig into what the numbers actually mean. Where does the 20% rule come from? The 20% down payment guideline comes from two places. First, it's the threshold at which you avoid private mortgage insurance on a conventional loan, the lender protecting insurance you pay for that we covered in Chapter 3. Second, it historically represented a meaningful equity cushion that reduced the lender's risk. If you put 20% down and the market dropped slightly, the lender still had collateral worth more than the outstanding loan balance. From a lender's perspective, 20% down is ideal. From a buyer's perspective, it is sometimes practical and sometimes wildly impractical depending on your market, your income, your savings rate, and your life circumstances. In expensive markets, think major coastal cities, high-cost suburban areas, 20% of a median home price might be $100,000, $150,000, $200,000 or more. Saving that amount while also paying rent, funding retirement, managing student loans, and living a reasonably human life can take a decade or more for many people. The question of whether spending that decade continuing to rent while you save is financially better or worse than buying sooner with less down is genuinely complicated, and the answer is different for different people in different markets. What I want you to understand is that 20% down is not a legal requirement, not a moral imperative, and not the only reasonable choice. It is one option on a spectrum, and different positions on that spectrum have different trade-offs that are worth understanding explicitly. The real down payment landscape. What's actually available? Let's walk through the actual options. Conventional loans with 3 to 5% down. Fannie Mae and Freddie Mac, the government-sponsored enterprises that back most conventional mortgages, allow down payments as low as 3% for first-time buyers through certain programs and 5% for repeat buyers on standard conventional loans. These are real, widely available mortgages from mainstream lenders. They come with PMI requirements until you reach 20% equity, but PMI is a known, manageable cost, not a financial catastrophe. FHA loans with 3.5% down. Federal Housing Administration loans allow 3.5% down for borrowers with credit scores of 580 or above, and 10% down for scores between 500 and 579. FHA loans are often more accessible for buyers with imperfect credit or lower income because of their more flexible underwriting standards. The trade-off, as we discussed, is the mortgage insurance premium that stays for the life of the loan in many cases. VA loans with 0% down. If you're an eligible veteran, active duty service member, or qualifying surviving spouse, VA loans allow you to buy a home with no down payment, no PMI, and competitive interest rates. VA loans are arguably the single best mortgage product available for those who qualify. There's a funding fee, typically 1.25% to 3.3% of the loan amount depending on circumstances, that can be rolled into the loan, but there's no ongoing mortgage insurance. If you qualify for a VA loan and you're not using it, you may be leaving significant money on the table. USDA loans with 0% down. The U.S. Department of Agriculture offers zero-down loans for homes in eligible rural and some suburban areas. Income limits apply, and not all areas qualify, but for buyers in eligible locations, USDA loans can be a powerful option. There is an upfront guarantee fee and an annual fee, similar to PMI, but no traditional down payment requirement. Down payment assistance programs. Almost every state has multiple down payment assistance programs, grants, forgivable loans, or low-interest second mortgages designed to help first-time buyers, and sometimes repeat buyers in certain circumstances, bridge the gap. Some are income-limited, some are occupation-specific, teachers, healthcare workers, first responders. Some are geography-specific. Many people who would qualify for these programs have never heard of them. The HUD website maintains a state-by-state directory of approved housing counseling agencies who can connect you with these programs, and your state's housing finance agency is another good resource. A mortgage broker who works with first-time buyers will often know what's available in your area. What? Different down payment amounts actually cost you monthly. Let's make this concrete with numbers. We'll use a $350,000 home purchase as the baseline, with a 7% interest rate on a 30-year fixed mortgage, and we'll run through 4 down payment scenarios. Scenario A, 3% down, $10,500, loan amount, $339,500 monthly, P and I, $2,260 P, M, I, estimated 0.9%, $255, total monthly, P and I plus P, M, I, $2,515, Scenario B, 5% down, $17,500, loan amount, $332,500, monthly P and I, $2,214, PMI, estimated 0.8%, $222, total monthly, P and I plus PMI, $2,436, Scenario C, 10% down, $35,000, loan amount, $315,000 monthly, P and I, $2,096 P, M, I, estimated 0.7%, $184, total monthly, P and I plus PMI, $2,280, Scenario D, 20% down, $70,000, loan amount, $280,000 monthly, P and I, $1,863 P, M, I, $0 total monthly P&I only, $1,863. The difference between 3% down and 20% down is $652 per month. That's meaningful. Over a year, it's $7,824. Over 5 years, it's $39,120. That's real money. But here's the other side of the ledger. To go from 3% down, $10,500, to 20% down, $70,000, you need an additional $59,500 in cash. If that $59,500 were instead invested in a diversified stock portfolio and it earned even a conservative 7% average annual return after 30 years, it would be worth approximately $452,000. Now, home equity is also a form of wealth building, and the calculations get complex quickly when you factor in home appreciation, the tax treatment of mortgage interest, and many other variables. The point isn't that renting while investing is always better than buying with a smaller down payment. It isn't always. The point is that the decision of how much to put down is a real financial trade-off with costs and benefits on both sides, not a simple case of more down payment is always better. The down payment sweet spots. Given all of this, what down payment amounts actually make the most sense in practice? Here's a framework. The 3 to 5% range makes sense when you're a first-time buyer in a market where home prices are rising and you'd be saving for years to reach 20%. You have stable income and a genuine long-term commitment to the property. You've accounted for PMI in your budget and have sufficient emergency reserves after the down payment. It does not make sense when the down payment leaves you with no emergency fund. The PMI brings your total housing cost to a level that genuinely strains your budget. Or you're buying in a market where prices are declining and you're at risk of being underwater quickly. The 10% range often hits a useful sweet spot. Meaningfully lower loan amount than 3 to 5% down. PMI is lower than at minimal down payments, and you're not depleting your entire savings to hit 20%. The 20% threshold makes strong sense when you have the savings available without depleting reserves. PMI avoidance represents significant ongoing savings. You're buying a higher-priced home where PMI costs are substantial, or your budget is tight enough that eliminating PMI makes the difference between comfortable and uncomfortable. Going above 20% to 25%, 30% more generally makes less financial sense than directing those excess funds to retirement accounts, particularly tax-advantaged ones like a 401k or IRA. The guaranteed return of avoiding mortgage interest is often lower than the expected long-term return of equity investing, especially once you've already hit the PMI threshold. Where do people actually get down payment money? Let's be real about this, because the official guidance often sounds like it's addressed to someone who simply needs to save diligently for a few years, and the money will materialize. Sometimes that's true. Often it's more complicated. Personal savings is the obvious answer, and for many buyers it is in fact the primary source. If saving for a down payment is your goal, there are a few things that accelerate the process. A dedicated high-yield savings account. Rates vary, but these are meaningfully better than traditional savings accounts. Aggressive reduction of discretionary spending, increasing income through side work or job advancement, and the uncomfortable but effective step of tracking every dollar you spend for at least a few months to find the leaks. Gift funds from family are extremely common and increasingly necessary in high-cost markets. Lenders allow down payment gifts from family members in most cases, but they have documentation requirements. You'll need a signed gift letter confirming the money is a gift and not a loan, and the lender will likely want to see the transfer documented in your bank statements. If you're fortunate enough to have family who can help, this is a legitimate path that many people use without advertising it. Down payment assistance programs, as mentioned above, genuinely underutilized, worth researching aggressively. 401k loans and withdrawals. Some retirement plans allow you to borrow against your 401k balance for a home purchase, typically up to 50% of your vested balance or $50,000, whichever is less. The loan is repaid through payroll deductions. This has the advantage of not triggering taxes or penalties the way a withdrawal would, since you're borrowing from yourself and repaying with interest, which also goes back to you. The risk. If you leave your employer before the loan is repaid, it typically becomes due quickly, and if you can't repay it, it becomes a taxable distribution plus penalties if you're under 59 and a half. Not ideal, but for some buyers, it's a bridge. First-time buyers can also make a penalty-free withdrawal of up to $10,000 from an IRA for a home purchase. Taxes still apply on traditional IRAs. It's not a lot of money in the context of most home purchases, but it's an option. Proceeds from selling existing assets, stocks, bonds, a car, a business, are a legitimate source. Keep in mind that selling appreciated investments may trigger capital gains taxes. Seller concessions don't technically increase your down payment, but they reduce the cash you need at closing by having the seller cover some closing costs. In some market conditions, sellers are willing to do this. In hot markets, sellers have no incentive to negotiate. What down payment is definitely not smart. A few sources that are worth explicitly flagging as bad ideas. Wiping out your emergency fund entirely to maximize your down payment. An emergency fund isn't a luxury. It's the buffer that prevents a car breakdown or a medical bill or a job disruption from becoming a financial crisis. Buying a house with zero emergency reserves is genuinely risky. Most financial advisors recommend keeping at least 3 to 6 months of expenses liquid even after closing. If your down payment leaves you with nothing, you need to either recalibrate the down payment amount or wait until you've built more savings. Taking out a personal loan to fund a down payment. Lenders check this. Most loan types prohibit borrowed funds as a down payment, with certain structured exceptions. And stacking a personal loan on top of a mortgage dramatically increases your debt load at the moment you're taking on a major financial commitment. This is a recipe for being overextended, rating retirement accounts beyond what makes sense at your age and timeline. The math of retirement compounding means that withdrawing significant funds early, especially in your 20s and 30s, has an outsized long-term cost. The $20,000 you take from your retirement account at 30 isn't just $20,000, it's the $150,000 or more that some would have grown to by retirement at typical market returns. Only you can decide whether a home purchase is worth that trade-off, but go in with eyes open. The down payment and your post-purchase financial health. There's a principle in personal finance called not being house poor, and the down payment is one of the key levers for avoiding it. Being house poor means you technically own a home, but you have no financial flexibility, no savings, no emergency fund, no retirement contributions, no room in the budget for anything unexpected. You live in the house, but you can't really live your life. One of the most common ways people become house poor is by putting every available dollar into the down payment, getting the lowest possible mortgage payment, and then not having any reserves left when the house inevitably needs something. The goal is not to minimize your mortgage payment in isolation. The goal is to optimize your entire financial picture in down payment, monthly payment, reserves, ongoing costs simultaneously. A slightly smaller down payment that leaves you with a solid emergency fund and continued retirement contributions is often better than a larger down payment that leaves you financially naked. This is counterintuitive to people who've been told for years that paying less interest is always the priority. It's not always the priority. Liquidity has value. Financial resilience has value. The ability to absorb a shock without a crisis has value. These things matter, and they matter more than shaving $50 a month off your mortgage payment. Chapter 6. Your lifestyle, your call. Building a number that actually fits your life. We've now covered a lot of ground. We've demolished the rules of thumb, understood the lender's framework, cataloged the true costs of home ownership, stared into the abyss of what interest rates actually cost over time, and worked through the down payment decision from multiple angles. That's a lot of information. Good information. Real information. But here's the thing. None of it automatically gives you your number. Your number, the amount of house you can actually, comfortably, sustainably afford without sacrificing your life, your sanity, or your long-term financial health, is personal. It depends on variables that a calculator can't know. It depends on who you are, what you value, what your life looks like now, and what you want it to look like in 10 years, and how much financial risk you can genuinely absorb without losing sleep. This chapter is about building that personal number. Not the bank's number, not the rules of thumb number. Yours. Step 1. Start with take-home pay, not gross income. We've said this before, but it's worth repeating as a first principle. Your budget should be built on your actual take-home income, not your gross salary. Your gross salary is a number on a piece of paper. Your take-home pay is the money you can actually spend. Every affordability framework you use, every ratio, every ceiling, every guideline should be based on net income because that's what you're working with. If you have a variable income, freelance, commission-based, seasonal, use a conservative figure. Average your last 2 years of actual net income, then use the lower of the average and your most recent year. Variable income is wonderful when it's flowing and terrifying. When it's not. Build your housing budget around a number you can sustain in a mediocre year, not an exceptional one. Your good years create the surplus. They should not be the foundation. Step 2. Build a complete, honest monthly budget. Before you can know how much you can afford on housing, you need to know what you're currently spending on everything else, and what you want to spend on everything else going forward. This means actually looking at your numbers, bank statements, credit card statements, subscription history, the whole picture. Most people who do this exercise are surprised by something, usually several somethings. The subscriptions that quietly auto-renewed. The dining out that adds up to more than they realized. The Amazon purchases that exist as vague memories and specific charges. Build a monthly budget that includes fixed expenses, current rent or housing, car payments, insurance, car, health, life, loan payments, phone, internet, variable, necessities, groceries, gas or transit, utilities, if not currently included in rent, healthcare out-of-pocket costs, discretionary spending, dining out, entertainment, shopping, hobbies, subscriptions, personal care, gym, travel, annualized and divided by 12, savings and investments, emergency fund contributions, retirement contributions, beyond what comes out automatically, include your 401k as an expense, even though it's deducted before you see it, because it's a real use of your income. Other savings goals, irregular expenses, car maintenance, medical expenses, gifts, holiday spending, travel. These don't happen every month, but they happen. Annualize them and divide by 12 to get a monthly figure. Once you have all of this, subtract the total from your take-home income. Whatever's left is currently either going to savings, going unaccounted for, or going somewhere you haven't identified yet. If the number's small, you have limited room for a higher housing payment. If it's substantial, you have more flexibility. Now, when you move to a new housing payment, your current rent disappears from the expense column and gets replaced by your total monthly housing cost. Mortgage payment, taxes, insurance, PMI, if applicable, HOA, if applicable, and a maintenance reserve. Calculate the difference between your current housing cost and your projected new one. How does it change the budget? What's left? Step 3. Protect the non-negotiables. Before you decide what you can afford on housing, decide what you won't sacrifice. These are your non-negotiables, the financial commitments that your housing cost cannot compromise. For most people, the non-negotiables should include at least these 3: an emergency fund of 3 to 6 months of expenses, not 3 to 6 months of mortgage payments, 3 to 6 months of total living expenses kept in a liquid account, not touched for ordinary expenses. This is your financial immune system. Houses break, jobs get disrupted, medical things happen. Without this buffer, any of those events becomes a crisis. With it, they're inconveniences. The emergency fund is not optional. Retirement contributions at a meaningful rate. The specifics of how much are debatable. Common guidance is 10 to 15% of gross income, but the principle isn't. If buying a house requires you to stop contributing to retirement entirely, you're not actually in a position to buy this house at this price. Compound growth is ruthlessly time-sensitive. Years of non-contribution in your 30s and 40s cost far more than the raw dollar amount suggests, because those dollars would have been working for decades. Protecting your retirement contributions is protecting your future self, enough to eat and live without constant anxiety. This sounds obvious, but it's worth stating. If making the mortgage payment every month will require you to stress over grocery bills, skip the doctor when you need to go, and lie awake. Doing mental math about whether you can afford a car repair. That is not a sustainable housing situation. Financial stress is corrosive. It affects your health, your relationships, your professional performance, and your quality of life. A cheaper house that allows you to live without constant financial anxiety is genuinely worth more than an expensive house that technically gets paid but slowly grinds you down. Once you've established your non-negotiables, the maximum you can spend on housing is whatever's left after funding those non-negotiables comfortably, not desperately. Step 4. Think about your life trajectory. One of the most important factors in how much house you can afford is something no calculator can input. Where is your life going? Are you likely to have children in the next few years? Children are expensive. Childcare alone in many markets runs $1,500 to $3,500 per month per child, which is a significant addition to your budget that doesn't exist today. A housing payment that's comfortable pre-children may be significantly less comfortable once you're paying for daycare, school supplies, extracurriculars, and the endless avalanche of things children require. Are you in a stable career or a transitional one? If your income is likely to grow substantially over the next 5 years, that gives you more room to stretch slightly today. If your field is uncertain, if your industry is contracting, if you're considering a career change that might temporarily reduce your income, these are reasons to buy conservatively and maintain more financial flexibility. Are you buying alone or with a partner? Two-income households have more buying power, but also more complexity. If your affordability calculation depends on 2 incomes, and one of those incomes disappears temporarily, job loss, career break, a period of caregiving, can you sustain the mortgage on 1 income? Ideally, the answer is yes, or at least yes for long enough to make adjustments. Buying a house that requires both incomes at full capacity to stay afloat is buying a house that's one disruption away from a crisis. Are you planning to stay in this location long term? The conventional wisdom used to be that you should plan to stay in a home for at least 5 years to make the purchase financially worthwhile, covering closing costs, building enough equity to offset transaction costs on the way out. That guidance still has merit. If there's a real possibility you'll relocate in 3 years, the financial case for buying is weaker, and buying less, or renting, may actually serve you better. Step 5. Apply a stress test. Before you finalize your number, run it through a few stress scenarios. These are not predictions, they're sanity checks. Income stress test. If your income dropped by 20 to 25%, a pay cut, a job change, a period of reduced hours, could you still make the mortgage payment? Not comfortably necessarily, but survivably? If the answer is no, you're at or beyond your actual limit. Rate stress test for ARMs. If you're considering an adjustable rate mortgage, what does your payment look like at the cap? Can you live with the worst case payment? If not, the ARM is not actually affordable in the full sense of the word. Repair stress test. If you had a $10,000 repair in year 2, a new furnace, a roof issue, a foundation problem, could you handle it without going into high interest debt or falling behind on the mortgage? If you'd have no way to cover it, you either need more savings before buying or need to buy less house and maintain a larger financial cushion. Life change stress test. Marriage, divorce, a child, a parent needing support, a health issue, a career transition, life changes. Could you handle any of the most plausible changes in your life circumstances while still managing this housing payment? If your stress tests come back with multiple, probably not answers, you're at the edge of your actual affordability. If they come back with uncomfortable but survivable, you're in reasonable territory. If they come back with completely fine, you may have more room than you thought, or you've done an excellent job of buying within your means. Step 6. Understand the buy versus rent question for your market. Here's the conversation that gets remarkably little airtime in home buying discussions. Renting is not inherently inferior to buying. In some markets, at some moments in time, renting is the financially smarter choice. In others, buying is clearly better. And in many cases, it's genuinely a wash financially, and the decision comes down to factors that aren't about money at all. Stability, customization, community, flexibility, the desire to plant something permanent and call it yours. The rent versus buy calculation depends heavily on the price-to-rent ratio in your market, the ratio of a home's purchase price to its annual rent equivalent. You can calculate this by dividing the median home price in an area by the annual median rent for a comparable property. A price-to-rent ratio below 15 generally favors buying. Between 15 and 20 is a gray zone. Above 20 generally favors renting from a pure financial standpoint, because the cost of ownership is high relative to what it would cost you to rent the same property. In some expensive coastal markets, price-to-rent ratios have historically been above 30 or even 40. In these markets, the financial case for renting and investing the difference is often quite strong. In more affordable markets, the ratio may be below 15, and buying is clearly advantageous. This doesn't mean you shouldn't buy in a high-ratio market. Non-financial factors, stability, schools, the desire to own, the emotional value of a permanent home matter enormously and are not captured by a price-to-rent ratio. But it does mean you should be honest with yourself about whether buying in an expensive market is a wealth-building decision or primarily a lifestyle decision. Both are legitimate. They're just different, and they deserve honest labeling. Step 7. Set your own ceiling below the bank's after working through all of this. Your real take-home income, your complete expense picture, your non-negotiables, your life trajectory, your stress tests. You should have a number, or at least a range. That number is almost certainly lower than what the bank will approve you for. That's correct. That's the point. The bank's number is the maximum from their perspective. Yours should be the maximum from your perspective, which is a fundamentally different calculation. A few practical anchors for setting your ceiling. Your total monthly housing cost, including everything from Chapter 3, should probably not exceed 25 to 30% of your actual take-home income if you want to maintain meaningful financial flexibility. Some people run tighter than this successfully, but 30% of take-home is a reasonable upper limit for most people in most circumstances. You should have at least 3 to 6 months of expenses in cash after closing, not counting retirement accounts. If you don't, either save more before buying or put less into the down payment and preserve the cash. Your housing payment should allow you to continue retirement contributions at a meaningful rate without significant reduction from your current savings rate. Your budget after housing costs should leave genuine breathing room, enough for the irregular expenses of life, some discretionary spending that makes life enjoyable, and a modest surplus each month. Not just surviving, functioning. A word on the emotional reality of this decision. All the math in the world doesn't fully account for the emotional dimension of buying a home, and it would be dishonest to pretend otherwise. Buying a home is one of the most emotionally charged financial decisions most people ever make. It involves your sense of security, your identity, your vision for your life, your relationships with partners and families, your feelings about the future, your desire to belong somewhere permanently. These things are real. They don't disappear because we've spent a chapter building a spreadsheet. There will be a house you want more than the math strictly allows. Maybe it's in the neighborhood where you grew up. Maybe it has the exact kitchen you've been imagining. Maybe it just feels right in a way that's hard to articulate. That pull is real, and I'm not going to tell you it should be ignored entirely. But here's the honest framing. The best house for you is not the most expensive house your lender will approve. It's not even necessarily the house that maximizes every feature on your wish list. The best house for you is the one that fits your financial life comfortably enough that you can actually enjoy living in it. Not just own it, but enjoy it. A house that makes you financially anxious every month is not a happy home. The upgrades and the extra bedrooms and the nicer neighborhood are not worth the sustained stress of a payment that never stops feeling like a stretch. Buy the house that fits your life, not the one that requires your life to fit the house. That's the whole point of this video, distilled into one sentence. Everything we've covered, the ratios, the true costs, the interest calculations, the stress test, has been in service of that principle. Putting your number together. A practical summary. Let's consolidate the process into clear steps. Start with your actual monthly take-home pay, not gross, net. Subtract all non-housing fixed and variable monthly expenses, everything except current rent or housing. Be honest. Look at actual spending, not idealized spending. Subtract your target savings, emergency fund contributions, retirement contributions, any other savings goals you're committed to. What remains is your maximum available for housing. From that, subtract estimates for property taxes, homeowners insurance, PMI if applicable, HOA fees if applicable, and a monthly maintenance reserve at minimum 1% of purchase price annually divided by 12. What's left after those subtractions is your maximum monthly principal and interest payment. Run that through a mortgage calculator at the current interest rate for your expected loan term to determine your maximum loan amount. Add your down payment to get your maximum home purchase price. Then, and this is important, apply a margin of safety. Rather than buying right at the top of that number, consider buying at 85 to 90% of it. That 10 to 15% cushion is what gives you the ability to absorb life without a crisis. It's what allows you to take a career risk, start a family, handle a surprise repair, or survive a temporary income disruption without the house being in jeopardy. That cushion is not wasted money. It is the cost of financial resilience, and it is worth paying. This is not a formula designed to minimize how much house you buy. It's a formula designed to maximize how much house you can enjoy, because enjoying your home, living in it without financial dread, and still having a functional life outside of it is the actual goal. Not the number of square feet, not the neighborhood prestige, not proving that you can afford something impressive. The goal is a home that supports your life, not one that consumes it. Chapter 7. The mistakes that cost people. Thousands, and how to not make them. There's a specific kind of financial pain that comes not from bad luck or unforeseeable circumstances, but from entirely avoidable mistakes that other people have already made and documented extensively. The home buying process is absolutely riddled with these. People make the same errors over and over again, not because they're careless or uninformed, but because buying a home is complicated, emotional, time-pressured, and filled with professionals who have financial incentives that don't always perfectly align with yours. This chapter is a catalog of the most common, most costly mistakes home buyers make. The ones that either inflate the price you pay, inflate the cost of ownership, compromise your financial position, or cause you to buy the wrong house entirely. Some of these are financial mistakes. Some are process mistakes. Some are psychological ones. All of them are real. All of them are common. And all of them are avoidable if you know what to look for. Consider this chapter your field guide to not doing what the cautionary tales did. Mistake number 1, getting pre-qualified instead of pre-approved, and treating either as a guarantee. Pre-qualification and pre-approval are not the same thing, and the difference matters more than most first-time buyers realize. Pre-qualification is a quick, informal assessment based on information you self-report, your income, your debts, your assets, without documentation. The lender runs no credit check, verifies nothing, and produces a letter that essentially says, based on what this person told us, they might be able to borrow around this amount. It's useful for getting a rough sense of where you stand, and it's basically worthless in a competitive market where sellers want to see real financial commitment. Pre-approval is a substantive process. You submit actual documentation, pay stubs, W-2s, tax returns, bank statements. The lender pulls your credit, verifies your income and assets, and issues a conditional commitment to lend you a specific amount subject to a satisfactory appraisal and a few other conditions. A pre-approval letter carries real weight with sellers because it means a human underwriter has actually looked at your finances. The mistake people make: getting only pre-qualified and then being surprised when their offer isn't competitive, or getting pre-approved and then treating it as a final guarantee when it's still conditional. Pre-approval can be withdrawn if your financial situation changes before closing. If you lose your job, take on new debt, or make a large purchase that the lender notices. Which brings us directly to the next mistake. Mistake number 2, making large purchases or opening new credit before closing. This one causes genuine heartbreak. You've had your offer accepted. You're under contract. You're 3 weeks from closing. You go out and finance a new car because your old one is unreliable and you need something dependable for the commute to the new house. Or you open a new credit card to take advantage of a sign-up bonus. Or you buy a bunch of furniture on a store credit account because you want to be ready on move-in day, and then your lender runs a final credit check, which virtually all lenders do in the days before closing, sees the new debt, recalculates your DTI, and your loan falls apart. Or at minimum, you spend a stressful week providing documentation and explanations while your closing date hangs in the balance. The rule is simple and inflexible. From the moment you apply for a mortgage until the moment you close, do not open any new credit accounts, do not make any large purchases on credit, do not finance anything, do not co-sign for anyone, and do not move large amounts of money between accounts without being prepared to document where it came from. This is not the time to optimize your credit card reward strategy. The house comes first. The furniture can wait until after you own it. Mistake number 3, skipping or skimping on the home inspection. In competitive markets with multiple offers and tight timelines, there's pressure, sometimes from buyers themselves, sometimes from agents, to waive the home inspection contingency in order to make an offer more attractive to the seller. This is a bet that occasionally pays off and occasionally results in discovering after closing that you've purchased a house with a failing foundation, active water intrusion, a mold problem, knob and tube wiring, or a sewer line that's 3 months from collapsing. A standard home inspection costs $300 to $600. Specialized inspections, sewer scope, radon test, mold test, structural engineer review, add a few hundred more. Call it $800 to $1,200 total for a thorough inspection package. Compare that to the cost of the problems inspections routinely uncover, and the math of skipping is never good. What a home inspection can reveal that changes your decision or negotiation: roof issues, not just needs replacement soon, but active leaking, improper installation, missing flashing, compromised decking underneath. Roof replacements run $10,000 to $25,000. HVAC systems at end of life. An inspector can often identify whether a furnace or AC unit is original to a 20-year-old house and therefore likely to fail within the next few years. Replacement: $5,000 to $12,000. Electrical problems. Older homes may have aluminum wiring, undersized panels, or DIY work that creates fire hazards. Electrical remediation can range from $1,000 for minor fixes to $10,000 or more for a full rewire. Plumbing issues. Cast iron pipes in older homes corrode. Polybutylene pipe from the 1970s and 1980s has a notorious failure history. Both are expensive to address. Water intrusion and moisture damage. Basements, crawl spaces, and poorly flashed windows are common culprits. Mold remediation and waterproofing can run from a few $1,000s to tens of thousands. Foundation cracks and settlement. Most foundation cracks are cosmetic, some are serious. An inspector can tell the difference, and if there's any question, a structural engineer's evaluation is $300 to $600 well spent. None of these are reasons to never buy an older home. Older homes have genuine charm, character, and often better construction quality in the bones than newer ones, but you need to know what you're buying. The inspection is how you know. Skipping it to make your offer look cleaner is gambling with what is likely the largest purchase of your life. If you're in a situation where waiving the inspection seems necessary to compete, consider an alternative. Do a pre-inspection before submitting your offer. Many sellers, with their agent's cooperation, will allow this. You pay for the inspection before you're even under contract, which means you've spent $400 with no guarantee of getting the house, but you've also protected yourself from buying a house with a serious problem, and your offer without an inspection contingency is more competitive because you've already done your diligence. Mistake number 4, falling in love before running the numbers. The human brain is a machine that makes emotional decisions and then constructs rational justifications for them after the fact. In home buying, this works against you in a very specific way. You walk through a house that hits all the right buttons, great light, nice kitchen, the right neighborhood, exactly the layout you wanted, and from that moment forward, your brain is no longer objectively evaluating the house. It's defending a decision that's already been made emotionally. This manifests in many ways. You rationalize away inspection findings that you'd consider deal breakers in a house you didn't love. You stretch your budget because this house is worth it. You ignore the fact that the commute is 45 minutes longer than you said you could live with because the backyard is so perfect. You make an offer 10% over asking because the idea of not getting it feels unbearable. None of this makes you a bad or irrational person. It makes you human. The house shopping process is specifically designed by everyone involved, including well-meaning agents, to generate emotional engagement with properties. Open houses are staged. Listings are photographed to maximize appeal. The entire experience is calibrated to make you fall in love. The defense against this is not to become a robot. It's to do your number running before you start seriously touring, not after. Know your ceiling before you walk through the first door. Write it down. Commit to it. When you fall in love with something above your ceiling, You'll still feel the pull, but you'll have a number you agreed to in advance when you were thinking clearly to anchor you. Also useful, the practice of making yourself articulate the negatives of every house you tour before you're allowed to articulate the positives. Force yourself to identify what doesn't work, what would need to be fixed, what the true costs are, before you let the enthusiasm take over. This sounds tedious. It is slightly tedious. It is much less tedious than owning a house you can't afford. Mistake number 5, treating your home, primarily as an investment homes do, tend to appreciate over time. The long-run average appreciation of U.S. home prices, adjusted for inflation, has historically been somewhere between 1% and 2% per year in real terms, meaning after inflation. That is not spectacular investment performance. The stock market has historically returned around 7% annually in real terms. The mistake is buying a home, too much home, in the wrong location with the wrong financial structure, because you're convinced it's an investment that will generate exceptional returns. When people say real estate always goes up, they're usually thinking of nominal appreciation without adjusting for inflation, without accounting for transaction costs. Typically 6 to 8% of the home's value when you factor in agent commissions and closing costs on both ends, without accounting for maintenance and improvement costs spent over the holding period, and without accounting for the interest paid on the mortgage. Run the full math on home ownership as an investment, including all carrying costs, and the returns are often quite modest. Maybe competitive with a bond portfolio, not competitive with a diversified equity portfolio. This is not an argument against home ownership. Homes provide shelter, stability, community, and a form of forced savings that many people wouldn't replicate by investing. But buying a house as a speculative investment, assuming it will appreciate dramatically and justify a price you otherwise can't comfortably afford, is a dangerous mindset. Markets that went up significantly have also gone down. People who bought in 2006 and 2007 at the peak of the prior bubble spent years underwater on their mortgages. Some never recovered. It always goes up is a statement that's been true over sufficiently long time horizons and false over many medium-term ones. Buy a home because you want to own it, because it fits your life and your finances, because the stability and rootedness of home ownership has genuine value to you. If it also appreciates, excellent, but don't buy a house you can't genuinely afford because you're counting on appreciation to bail you out. That is speculation, not investment, and it carries the risks that speculation always carries. Mistake number 6, ignoring the total cost of the neighborhood, not just the house. You're not just buying a house, you're buying into a cost structure that extends well beyond the property line, and some of those costs are highly location dependent. Property taxes, as we discussed, vary enormously, but so do other things. Car insurance rates vary significantly by zip code. The same car, the same driver, can cost meaningfully more to insure in one neighborhood than another based on theft rates, accident statistics, and other actuarial factors. Flood insurance, as discussed, can add thousands per year in certain zones. HOA fees, if applicable, vary dramatically. The cost of everything from groceries to gas to home services tends to be higher in certain markets. Beyond the direct costs, there are softer costs that people sometimes underestimate. A house that seems like great value because it's priced lower than comparables might be priced lower for reasons that translate into ongoing costs for you. A longer commute that adds hours to your week and miles to your car, a school district that leads you to pursue private schooling, a neighborhood that requires more security investment, proximity to commercial or industrial areas that affects noise levels or air quality in ways that matter to your quality of life. None of these are reasons not to buy in certain areas. Every buyer has their own priorities and their own tolerance for various trade-offs, but they should be counted. The house at $280,000 in a location that adds $600 a month in commute costs and $400 a month in property taxes compared to the house at $320,000 closer to work and in a lower tax jurisdiction is not obviously cheaper. Do the math for your actual situation. Mistake number 7, not understanding what's negotiable and not. Negotiating. Many home buyers, especially first-timers, approach the transaction as if the asking price is a fixed number that can either be met or not. This is not accurate. Almost everything in a real estate transaction is, at least in theory, negotiable. And leaving negotiation on the table is leaving money on the table. The obvious negotiation is on price. In most markets and most conditions, there is at least some room to negotiate below asking price. The degree of flexibility depends on the market, buyer's market versus seller's market, the days on market, the seller's motivation, and the presence of competing offers. Your agent should be providing you with comparable sales data, comps, that establish a reasonable value range for the property so you're negotiating from information rather than instinct. Less obvious but equally real negotiation levers, closing cost concessions. Rather than lowering the price, sellers can agree to contribute toward your closing costs, effectively reducing your out-of-pocket cash at closing. In some situations, this is more useful than a price reduction. Repairs and credits. After the inspection reveals issues, you can ask the seller to make repairs before closing, reduce the price to reflect the cost of repairs you'll need to make, or provide a credit at closing that you can apply toward those costs. Appliances and fixtures. What stays with the house is negotiable. The washer and dryer, the refrigerator, the backyard furniture, the window treatments, all potentially negotiable. Ask. Closing date flexibility. Sellers often have preferences about when they close. They may need time to find a new home, or may be eager to close quickly because they've already bought. Being flexible on the closing timeline in either direction can make your offer more attractive without changing the price. Home warranty. Many sellers will provide or contribute to the cost of a home warranty, typically a 1-year policy covering major systems and appliances as part of the negotiation. These cost a few $100s and can provide useful peace of mind in the first year. The broader point is that the transaction has many variables beyond price, and experienced buyers use multiple levers. An agent who is genuinely working in your interest, as opposed to working toward closing the deal quickly at any price, will help you identify and use these levers effectively. Mistake number 8. Choosing your real estate agent by default. Most people choose their real estate agent through personal referral or mild convenience. A friend recommended someone, or an agent sent a mailer, or the first name that came up in a Google search seemed fine. This is understandable. It's also potentially expensive. Your buyer's agent is supposed to be representing your interests. In practice, agent incentives aren't perfectly aligned with yours. Agents are typically paid a commission that's a percentage of the purchase price, which means they make more money when you buy a more expensive house, and they make no money if the deal falls through. Neither of those facts means your agent is actively working against you. Most agents are ethical and genuinely helpful, but it does mean that the agent's interests and yours diverge in certain specific moments, and you should be aware of those moments. Things to look for in a buyer's agent. Experience with buyers specifically, not just listing experience. Knowledge of the specific neighborhoods you're targeting, a communication style that works for you, an honest willingness to tell you not to buy something. An agent who tells you, "I don't think this house is worth the asking price," or "I'd be cautious about this inspection finding," is providing more value than one who cheerfully encourages every offer at every price point. Interview at least 2 or 3 agents before committing. Ask them about recent buyer transactions they've closed, what their process is for helping buyers set budget boundaries, and how they handle inspection findings in negotiations. You'll learn a lot from those conversations. Mistake number 9. Underestimating how long the process takes. People begin house hunting with an idea of a timeline that is almost always too optimistic. "We'll start looking in spring and be in a new house by summer" is a sentence that experienced homeowners hear and nod at knowingly. The reality, from beginning a serious house search to closing, the average process takes 3 to 6 months for buyers who find a home relatively quickly. It can easily take longer in competitive markets if financing complications arise or if the first few offers don't succeed. The search itself varies enormously. Some buyers find a home in weeks, others search for a year or more. Once you're under contract, the period from accepted offer to closing typically runs 30 to 60 days, during which the inspection, appraisal, mortgage underwriting, title search, and closing preparations all need to be completed. Why does this matter for affordability? Because the longer the process, the more time your financial situation has to change, for better or worse. More time for rates to move. more time for your employment situation to change, more time for the market to shift, and if you're renting month to month while you search, more time paying rent without building equity. The practical implication: get your finances in order before you start seriously looking, not after. Get pre-approved before you fall in love with a house. Have your down payment funds consolidated and documented. Know your numbers. The buyers who are ready to move quickly when they find the right house are far better positioned than the ones scrambling to get their financial documentation together while the house goes to someone else. Mistake number 10. Not planning for the first year. The first year of homeownership is financially different from every subsequent year. You've just made a large down payment and paid closing costs. You may have moved expenses. You'll likely want, or need, to make some improvements or adjustments to the home. And the house itself, freshly inhabited by new people with new usage patterns, has a way of introducing itself through whatever was about to fail. Many first-time buyers don't plan for this transition year adequately. They've saved for the down payment and the closing costs, and they've confirmed that the monthly payment fits their budget, but they haven't thought about the additional cash demands of the months immediately following closing. Some things to budget for in year one beyond the mortgage. Moving costs, which depending on distance and the amount of stuff you have can range from a few $100s to several thousand. Immediate improvements, paint, fixtures, hardware, cosmetic updates that make the house feel like yours. Even just paint for a whole house costs more than people expect once you factor in supplies or professional labor. New furniture and window treatments for rooms that are different sizes or configurations than your previous home. Lawn and yard equipment if you're going from renting to owning a yard for the first time. A basic setup, mower, trimmer, basic tools, can easily run $500 to $1,500. The first repair or maintenance event, which often happens within the first year. Not always, but often enough that you should be prepared. Utility deposits and setup costs, if applicable. None of these are catastrophic individually. Together, in the first year, they can add up to $5,000 to $15,000 in first-year costs beyond the down payment and ongoing mortgage. More if you're doing any significant renovations, budget for them. Don't let the first year of homeownership feel like a financial emergency just because you underestimated the transition costs. Mistake number 11. Letting the market pressure you into buying the wrong house. This is the subtlest mistake on this list, and in some ways the most dangerous, because it doesn't feel like a mistake while it's happening. It feels like pragmatism. Here's how it goes. You've been searching for a while. The market is competitive. You've had a couple of offers rejected. You're tired. Your lease is up in 2 months. Your parents are asking when you're going to just pull the trigger, and a house comes on the market that isn't quite right. It's over your budget, or in a neighborhood that wasn't your first choice, or with a floor plan that has an awkward layout you know will bother you. But you're tired and you make an offer anyway, and you get it. Sometimes this works out fine. The house grows on you. The neighborhood turns out to be better than you thought. The budget stretches more manageable than you feared. And sometimes you spend the next 5 years living in a house you don't love, in a neighborhood that doesn't suit you, under a financial pressure you resent, counting down to the moment you can sell it without losing money. Real estate has a concept called golden handcuffs. When you've bought a house at a price or a rate or a moment in the market that makes selling feel financially painful, but staying also feels wrong. People who bought the wrong house for the wrong reasons often find themselves in exactly this situation. The antidote is patience. It is genuinely better to wait, to rent longer if you need to keep looking until the right house at the right price in the right location comes up, than to buy the wrong house because you're tired of looking. There will always be another house. The housing market, regardless of how it appears at any given moment, will always eventually produce more inventory, more opportunities, more right houses. You are not going to miss your last chance to ever own a home because you passed on a particular property on a particular Tuesday. Buy the right house at the right price. If it takes longer than you hoped, let it take longer. The discipline of waiting for the right thing is one of the most valuable skills in personal finance generally, and home buying specifically. There it is. Chapter 7, at approximately 3,400 words, bringing the script to roughly 26,000 words total. But you said you need 5,000 more, so I'll keep going immediately with Chapter 8. Chapter 8, the timing question. When is the right time to buy? Every generation of homebuyers has believed, at some point in their search, that they are operating in uniquely terrible conditions. Too competitive, too expensive, too uncertain, rates too high, inventory too low, everyone before them had it easier. This is partly true and partly a cognitive illusion produced by the emotional weight of the decision. Every era has had its obstacles, its risks, its people who bought at what looked like the worst possible moment and turned out fine, and its people who waited for perfect conditions and kept waiting indefinitely while life moved on without homeownership in it. The timing question is real, though. The decision of when to buy has genuine financial implications, and it's worth thinking through clearly rather than either dismissing it entirely, the best time to buy is always right now, or treating it as the dominant variable that overrides everything else. The market timing problem. Let's start with what you can't control: macroeconomic conditions. Interest rates are set by forces that have nothing to do with your personal situation. Housing inventory is determined by local market conditions, construction activity, demographic shifts, and owner behavior that you have no influence over. Home prices in your target market are set by the aggregate behavior of buyers and sellers in that market, not by what you personally need them to do. Trying to time the housing market the way some people try to time the stock market is largely a fool's errand. People have been predicting housing market corrections confidently for years. Sometimes they're right, often they're wrong, and they're almost never right about the specific magnitude and timing simultaneously. The people who refused to buy in 2019 because the market felt overpriced watched prices climb substantially in 2020 and 2021. The people who bought in early 2022, right before rates started rising, significantly paid prices that were near the peak and immediately faced higher financing costs. The people who waited for rates to fall in 2023 and 2024 waited and kept waiting. Nobody rings a bell at the bottom. Nobody sends you a notification when conditions are objectively ideal. The housing market, like all markets, is information efficient enough that by the time its obvious conditions are favorable, many other buyers have already acted on that information. What this means practically: don't wait for perfect. Don't wait for rates to hit a specific target. Don't wait for prices to fall to a number you've decided is fair. These things may or may not happen, and constructing your life around a hoped-for market condition is a form of paralysis dressed up as financial prudence. The right personal timing, what you can control, and what matters far more than macroeconomic conditions, is your personal readiness. And personal readiness has multiple dimensions that are worth assessing honestly. Financial readiness is the most obvious one, and the one this entire video has been building toward. You're financially ready to buy when you have a stable, documentable income sufficient to qualify for and comfortably carry the mortgage. You have a down payment that won't leave you financially naked after closing. You have an emergency fund in place. You're not carrying high-interest consumer debt that would strain your budget alongside a mortgage. And your credit profile is strong enough to get you competitive. Financing. If any of these conditions aren't met, the timing isn't right from a financial perspective, regardless of what interest rates are doing. The answer in that situation is to address what's not ready, not to rush into a purchase because conditions feel temporarily favorable. Life readiness is equally important and often less discussed. Buying a home makes the most financial and practical sense when you have reasonable confidence you'll stay in the area for at least 5 years, ideally longer. Transaction costs on both ends of a home purchase, typically 8 to 10% total between buying and selling costs, mean that short holding periods eat significantly into any appreciation gains and often result in losing money, even in rising markets. If your job might relocate you, if your relationship status is uncertain in ways that would affect the purchase, if you're considering a major career change that might require moving, if there are family circumstances that could pull you to a different city, these aren't reasons to never buy. They're reasons to think carefully about the timing, because buying and selling in a short window is genuinely expensive and potentially financially damaging. The rate environment, what to do with it. Since rates are a major driver of affordability and a major topic of anxiety for buyers in any given moment, let's address the rate timing question directly. The most dangerous piece of advice circulating in any high-rate environment is wait for rates to come down. This advice is dangerous not because rates never come down, they do, but because it contains several hidden assumptions that are all wrong simultaneously. Hidden assumption 1. Rates will come down meaningfully soon. Maybe. Nobody knows. Rates can stay elevated for years. Anyone telling you with confidence that rates will be significantly lower in 12 or 18 months is speculating, not analyzing. Hidden assumption 2. When rates come down, home prices won't compensate. This is the critical one. When mortgage rates drop significantly, purchasing power increases, which means more buyers can afford more house, which increases demand, which puts upward pressure on prices. Lower rates don't automatically mean lower monthly payments if prices rise to absorb the improved affordability. The relationship between rates and prices is real and documented. Rate drops tend to stimulate demand and push prices up, at least in markets with constrained supply. Hidden assumption 3. You'll be able to buy the house you want at the price you want when rates drop. Not necessarily. If rates drop meaningfully, competition increases, inventory tightens relative to demand, and the buying environment often becomes more difficult even as financing costs fall. The actual advice for high-rate environments: buy the right house at the right price at the right time for your personal life, finance it with the best rate you can get today, and if rates drop meaningfully in the future, refinance. This strategy, sometimes summarized as date the rate, marry the house, captures the key insight that you can change your financing later, but you can't change the house you already passed on. The counterweight: don't use "I can always refinance" as a rationalization for buying too much house. A refinance requires you to qualify again, pay closing costs again, and depends on rates actually dropping. It's a reasonable expectation in some environments, it's not a guarantee. The rent while saving strategy: when it actually makes sense. Sometimes the right answer to "when should I buy" is "not yet, and here's exactly what you're doing with the time." Continuing to rent while you build toward home ownership makes genuinely good financial sense when you're aggressively building your down payment and reserves, when your credit needs improvement, when your income is growing, and a year or two of patience will materially improve what you can qualify for, or when your life circumstances are genuinely uncertain enough that buying now would be a significant risk. The key word in all of those is intentionality. Renting while building toward a goal is a strategy. Renting indefinitely while vaguely hoping conditions will improve is not a strategy. It's avoidance dressed in financial language. If you're going to rent while you save, build a specific plan, a target down payment amount, a target credit score, a target savings timeline, and a trigger, the conditions under which you'll start seriously looking. Review the plan quarterly. Adjust as circumstances change, but have a plan, not just a hope that things will become clearer. A framework for making the timing decision. Here's a practical decision framework that cuts through the noise. Ask yourself 4 questions. 1. Do I meet the financial readiness criteria? Stable income, sufficient down payment without depleting reserves, manageable debt load, strong credit? If yes, proceed. If no, identify specifically what needs to change and how long that realistically takes. 2. Do I have reasonable confidence I'll stay in this area for at least 5 years? If yes, proceed. If no, the financial case for buying is weak regardless of other conditions. 3. Can I find a home in my target area that fits my actual budget, not the bank's maximum, but my number from Chapter 6, that I genuinely want to live in? If yes, proceed. If no, either wait for the right property or reassess whether your budget matches your target market. 4. Are there specific personal circumstances, relationship uncertainty, career transition, family situation, that make a multi-year commitment to a location genuinely risky right now? If yes, address those first. If no, proceed. If you answered yes, 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 and no to those 4 questions, the timing is probably right. Not perfect. Timing is never perfect, but right enough, act. If you have a if, no in the first 2 or a yes in the 4th, wait. Not forever, not indefinitely, but until those conditions are genuinely resolved. The housing market will still be there. Better opportunities exist on the other side of being actually ready than on the near side of buying before you are. One last thought on timing: the decade perspective. When people agonize over whether this is the right moment to buy, whether rates are too high, prices too elevated, competition too fierce, they're usually thinking in a 1 or 2 year window. That's the wrong window. Zoom out to a decade. If you buy a house today and hold it for 10 years, paying down principal, building equity, and potentially benefiting from appreciation, do the specific conditions of the month you bought in matter that much? In most cases, no. The noise of short-term market conditions tends to disappear over 10-year holding periods. What matters over that horizon is whether you bought something you could afford, in a location that suited your life, at a price that wasn't wildly above the fundamental value of the asset. Get those big things right. Let the small things, whether rates are 6.5% or 7.25% this particular month, whether inventory is at 2.1 months or 2.8 months in your market, be the secondary considerations they actually are. The decade perspective doesn't make the short-term conditions irrelevant. It puts them in proportion. And proportion is what this entire video has been working toward. A clear-eyed, proportionate understanding of what you can afford, what it costs, what the risks are, and how to make a decision that serves your actual life. That's the work. It's not glamorous. It doesn't make for exciting YouTube thumbnails. But it is the work that separates the people who look back on their home purchase as one of the best decisions they ever made from the ones who look back and wish they'd known what they were actually getting into. Now you know. Conclusion. So, how much house can you actually afford? By now, you know the answer isn't a simple multiple of your income, and it isn't whatever the bank approved you for, and it isn't the result of a 2-minute online calculator that knows nothing about your life. The answer is built from your real take-home income, your actual expenses, your financial obligations, your goals, your savings needs, your risk tolerance, the true costs of the specific home in the specific location, the prevailing interest rate environment, and what you want your financial life to look like for the next decade or more. It is a personal number. It takes more than 5 minutes to calculate, and it is almost always lower than what lenders will offer you. That gap between the bank's number and your number is not a failure. It's the product of a system designed around the bank's interests rather than yours. The bank approves what it believes it can safely lend. You should borrow what you can comfortably live with. And those are genuinely different standards, answered by genuinely different questions. Let's do a quick recap of the major principles we've covered, because there's a lot here, and the summary matters. The rules of thumb: 28% of gross income, 2.5 times your salary, buy what the bank approves, are starting points at best and misleading shortcuts at worst. They are too simple for a decision this complex, they ignore too many variables, and they are built around the lender's perspective rather than yours. Know them, understand where they come from. Don't let them be your entire framework. The lender's framework, DTI, qualifying income credit score, is important to understand because it determines what you can access, not what you should borrow. Your back-end DTI at 43% might get you approved. Living with a 43% back-end DTI might be stressful, restrictive, and financially fragile. Understand the difference. The true cost of home ownership is the mortgage payment plus property taxes plus homeowner's insurance plus PMI if applicable plus HOA fees if applicable plus maintenance reserves plus utilities, not just the mortgage payment. When you use the true monthly cost in your affordability calculation, you get a much more realistic picture of what you're actually signing up for. Interest rates are not just a line item. They fundamentally determine your purchasing power and the total cost of the loan over time. A rate difference of even 1 percentage point can mean tens of thousands of dollars over the life of the loan and dramatically changes the home price you can sustain at a given monthly budget. Shop aggressively, understand what you're getting, and don't build your budget around a hoped-for refinance. The down payment decision is a trade-off, not a moral position. 20% down is not always right, neither is the minimum. The right down payment leaves you with an affordable monthly payment, no catastrophic PMI burden, and sufficient emergency reserves after closing. Optimize all three simultaneously, not just the mortgage payment in isolation. Your real affordability number comes from your take-home income, your actual expenses, your non-negotiable financial commitments, your life trajectory, and your stress tests. Build it from the bottom up, protect the non-negotiables, apply a margin of safety, and buy below the ceiling rather than right at it. And finally, The goal is a home that supports your life, a home that allows you to continue building toward financial independence, a home that doesn't collapse your budget when something unexpected happens, a home you can actually enjoy, not just technically afford. That's the target. Everything else in this video has been working toward that. Home ownership, done right, is one of the most powerful wealth-building tools and life-stabilizing decisions available. Done wrong, bought too much too soon with too little cushion, it can be a source of sustained financial stress that affects every other part of your life. The difference between those two outcomes is largely the number you choose when you answer the question this video started with. Now you have the tools to choose that number honestly, completely, and in service of your actual life rather than someone else's formula. Go find your number, then find the house that fits it, in that order.